Hi guys, I hope you're doing well. Welcome to this AAA Revision Marathon session. This is Luqman Rafiq in front of you. So welcome to this session. I hope that you people will inshallah learn and benefit a lot from this session. What is going to be my objective of today's session is that I would try to make sure that I go through the AAA paper with you people and try to actually make sure that I make you understand the different techniques that are needed for passing the AAA paper. So what we are going to do is that we are going to start off right now. And in case if any one of you have got any queries, any issues, any problems that you would like to actually discuss, you can actually go about discussing them as soon as you get a chance to discuss. Because what I would initially be doing is that I would initially be going through the different aspects and then I would actually take you people through. So let's just start off. Let's just start discussing. Okay. First of all, what I'm actually going to do is that I'm going to talk about the important areas of this AAA, and I'm going to tell you that how exactly can you actually prepare well for the examination. So as you are aware that the AAA examination, when it is examined, you've got multiple sections of the paper, and there's this section A of the paper. Then there is this section B of the paper. So for the section A of the paper, what actually happens is that in the section A of the paper, there is actually one question which is worth 50 marks. Whereas when it comes to the section B, you've got two questions, each of them is worth 25 marks each. I repeat, each of them is worth 25 marks each. Now, what exactly is examined majorly in these specific, what exactly is examined in these specific topics? So let's have a bit of a discussion about it. The number one thing is that with respect to this section A, the 50-mark question. So generally speaking, from the perspective of the exam, what is examined is that the examiner would actually either talk about the audit risk or he would either talk about the business risk. And in addition to this audit risk and the business risk scenario, there is going to be a small area about the ethical issues. And there could actually be some of the audit procedures that you may actually be required to draft. Plus, in addition to the audit procedures, there could actually be some other areas pertaining to this quality control, etc., etc. But that quality control is majorly examined in reference to the ethical issues. So that is one of the areas which is actually going to be examined, which is you would have this audit risk, the business risk, the ethical issues, audit procedures, etc., etc. And when it comes to section B, you've got two questions, and there is no specific topic that is going to be examined for these two questions. But what could actually happen is that you could have different type of question. One thing is confirmed that one of the question is about the other assignments or the other engagements. What are those other assignments? What are those other engagements going to be? So that could be ISRE scenario, that could be ISAE scenario, that could be ISRS scenario. So basically, there could be a related services question, there could be a question on the review engagements, there could be a question on the assurance engagement. So there could be multiple different type of questions that could be examined. Now, the next situation is that in addition to this, one of the question could actually include a lot of things. It could be about the audit report. It could be about the quality control. It could be about the ethical dilemmas. It could be about the performance of the audit procedures. So there could be multiple things that could actually be examined. Even this other assignments is hardly 15 mark. Even the 10 marks question pertaining to that specific area is also about the other areas of the syllabus. So when you would come across the AAA syllabus, you got to make sure that you're able to identify some of the areas. You got to practice some of the questions which are actually going to take you through. Now, what are those questions which you should practice? Like audit risk, around 3 questions. The business risk, around 3 questions. The group audit, in case if you don't find the audit risk and the group audit together, 2 questions. Then you should try to discuss the 2 questions, which is about the audit procedures. You should try to do at least 3 questions. The audit report, around 3 questions. Then what happens is that other engagements, 3 questions, each one for the prospective financial information. One of them could be for the due diligence. One of them could be for the other CSR, etc., etc. This could be one of them. Then what else do you need to do? You need to talk about this ethical, quality control, and professional issue. If you could do 2 questions. So basically 3 plus 3 is 6, 6 plus 2 is 8, 8 plus 3 is 11, 11 plus 3 is 14, 14 plus 3 is 17, or you could just add up. So 20 questions is what you should try to do, containing different topics. So like you might actually come across people, some of you might actually be, I repeat, some of you might actually be I repeat, some of you might actually be in a situation where you would say that I would be practicing more and more the audit risk scenario. Some of you might be in a situation you would actually be practicing more and more the audit procedure scenario. So just make sure that just don't stay focused on one specific area. You can actually go about focusing on different topics, because you see the wider coverage is important. If you just focus on one specific thing, that is not good. Focus on wider area, that is more important. That is more important, right? You get it? Now, so what my agenda and my objective is going to be, I would just try to make sure that I go through each and every area of the syllabus quickly, so that you could have a quick go through of the syllabus things. Now, the first thing that I'm actually going to talk about is the concept of business risk. Now, what exactly is the business risk from the perspective of the audit? So let's just have a discussion about it. Whenever we talk about the question, the examiner might actually ask you that evaluate the business risk in the given question. So if the examiner says that evaluate business risk in the following situation. So what is he actually asking? The examiner is actually asking you to evaluate the business risk. Now the word evaluate, when the examiner asks the word evaluate means to identify. The word evaluate means to explain. It's not just about identification, it's about identification and then explanation. So basically, when we talk about the concept of evaluating the business risk actually means you identify the risk. And then what happens is that after identification of the risk, what you should try to do is that you should try to actually, you should try to explain that what is actually going on. So that's what actually means evaluating the business risk. Now, so if the question about the business risk comes in, so how exactly are we going to answer that question? I'm going to guide you about it. First of all, you need to understand that what exactly is a business risk. I repeat, first of all, you need to understand that what exactly is a business risk. So when I talk about the business risk, the concept of business risk is that it's a risk So what exactly is a business risk? The business risk is actually a risk that the entity may not be able to achieve its objective. So whatever the objectives of as an organization, the entity may not be able to achieve those objectives. That is what is considered to be a business risk. So I repeat, what exactly is the business risk? When we talk about the concept of business risk, the concept of business risk is that the risk that the entity may not be able to achieve. I repeat, it's the risk that the entity may not be able to achieve its objectives. Now, so basically, what could be the different type of things that could actually have an impact on the business? So we could apply the pestle model, the political, economic, social, technological, environmental, and the legal. There is another model, which is the Porter Five Forces model. You could just apply these model to the organization, and you could think about it that how would these models have an impact upon the organization, and on this basis, you could just identify the business. So I repeat, when we talk about the business risk, you could just apply these models to any organization, and by applying the model, you could have an idea if the organization, what exactly are the risks that the organization is facing. Now, what could actually be the risk that the organization is going to face? So let's just have a discussion about it. Okay, so in order to identify the business risk, you could apply these models, which is the PESTEL, the Porter 5 Forces model. This PESTEL and the Porter 5 Forces model is actually going to tell you that if the organization is facing a risk or not. Like for example, what happens is that when it comes to the political aspects, the government in your country, the policies of the government could actually have an impact on the business. Like if there is an uncertainty in the policies, if the governments are frequently changing, so ultimately that would actually have an impact on the policies, and that policies could have an impact on the business. So ultimately what happens is that the political scenario could actually lead to the business risk. What is that risk? The business may not be able to achieve its objective. Like at times your country's government allows import, at times they disallow the import. At times your country government impose a regulatory duty, at times it does not impose a regulatory duty. At times they increase tax, at times they decrease tax. At times they give favor to the exporters, at times they don't give their favor to the exporters. So the governmental policies, the political scenario in your country could actually have a huge impact upon the business. So what could actually prevent you from achieving your business objectives? So your business objectives could be prevented from the governmental policies, from the political situations in your country, from the political scenarios. All this could have an impact on the business. Now, what next is there? Then what happens is that you could have the economic situation. What is this economic situation going to be? So the economic situations, which is the economic recession. I mean, you see the way the global economy is operating. You see nowadays it's the global recession. It's a recession across the globe. The US is actually increasing the interest rates just to make sure that it controls the inflation, just to make sure that it makes things easy for people. So because of that, the US dollar is becoming expensive in front of the other countries. And when the US dollar is becoming expensive in front of the other countries, so ultimately what happens is that it is becoming difficult for the countries to actually export things, and it's ultimately impacting the business. So the economic situation, the global economy, where there is an economic boom or where there is an economic recession, this could also have an impact on the business. So basically, the social aspects, the way the technological developments are actually taking place, the way the environmental changes are taking place, the way the legislations are being drafted, they all could have an impact on the business. They all could have an impact on the business. They all could impact the way the business is being conducted. So when I talk about, I repeat, when we talk about the concept of the business risk, what is the business risk? The business risk is the risk that the entity may not be able to achieve your objectives. And there could be multiple factors, there could be multiple risks, there could be multiple things that could prevent the business from achieving its objectives. You can even apply the Porter 5 Forces model. What is this Porter 5 Forces model going to be? So when you apply the Porter 5 Forces model, you talk about the customer power, you talk about the bargaining power of the supplier, you talk about the competitor, you talk about the barriers to new entry, and you talk about the alternate products. So like basically all these things could have an impact on the business. So the likelihood that the business would be able to achieve its objectives or not would actually be impacted by all of this, would actually be impacted by all of this. Let's move a bit forward and let's just try to understand further. So like I could give you certain situations, I could give you certain explanations as to what are the things that could actually help prevent a business from achieving its objectives. Now, amongst the certain things that could have an impact upon business achieving its objective is, just think about it. Let's say, for example, the increase in interest rates. In case if the interest rates increase, Ultimately, the increase in interest rate would mean what? The increase in the interest rate would actually mean that the business's financing costs are increased. And those increase in the financing costs could ultimately have an impact on the discount rates, could have an impact on the business running costs, could actually make positive NPV project turn into a negative NPV project, could be having a lot of impact. Now there could be exchange rate fluctuations. You see, if you are dealing in a foreign currency, the exchange rate fluctuations could again have an impact on your business. Then what happens is that if there is a high fixed cost that a business has, that could also have an impact. Now, what happens is that the volatile markets, volatile demand for the products, all of these things could have an impact on the business. So from the perspective of the exam, if you come across a scenario, I repeat, if from the perspective of the exam, if you come across a scenario where the examiner says that evaluate the business risk, so how exactly would you evaluate the business risk? So evaluation of the business risk would actually mean what? You would first of all identify the risk, and then you would explain how it could impact entity from achieving its objective, right? For example, when it comes to a risk, like let's say, for example, the an entity is dealing with the foreign currencies. So now I would just explain to you that how could we define the business risk. You could see the business risk could be defined as like this: significant portion of the entities, significant portion of the entities sales, significant portion of the entities sales are derived in the foreign currency. Abit, significant portion of the entity's sales are derived in the foreign currency. Now, the exchange rates are fluctuating, which impact the inflows. There is a risk that the exchange rates fluctuate adversely, resulting in reduction in the entity's sales. So you see, you got to evaluate the business risk. What exactly do you mean by evaluating the business risk? It's actually to identify the risk, and then after identifying the risk, what you do is that you actually, I repeat, what you do is that you identify the risk, and after identifying the risk, you actually say that how it could have an adverse impact on the business. Now, what next is there? So basically, one of the scenario is about the business risk. So from the perspective of the exam, I repeat, from the perspective of the exam, if you come across a question, I repeat, if you come across a question where the examiner says that there is a 16-mark question on a business risk, how exactly are you going to answer that? If the examiner says that there is a 16-mark question on the business risk, how exactly are you going to answer that? You're going to answer that like this. You would say that for these 16 marks, what are you going to do? You're going to say that maybe 2 marks for each risk. 2 marks for each risk. Now, what do you mean by 2 marks for each risk? So that would actually mean half a mark for the identification of the risk and 1.5 mark for 1.5 mark for actually explaining that why is it a risk. Explaining that why is it a risk. So if from the perspective of the examination, if we try to look at the scenarios, so one of the type of the question that comes in is about the business risk. And what is the business risk scenario? I've told you. Now let's move a bit forward and let's talk a bit further. The second type of scenario that you could come across is actually the audit risk. The second type of scenario that you come across is actually the audit risk. Now, what exactly is this audit risk all about? So when I talk about the audit risk is basically a risk that the auditor So I repeat, what exactly is the audit risk? The audit risk is the risk that the auditor will issue an incorrect audit opinion. The auditor will issue an incorrect audit opinion. Now let me just explain to you something, that how exactly is the auditor going to issue an incorrect audit opinion. Now, you know that there are different types of audit opinions, and those audit opinions could actually be uh, unmodified opinion. There could actually be a qualified opinion. There could be an adverse opinion, and there could actually be the disclaimer of opinion. So let me just guide you that the audit opinion could be of different types. It could be unmodified, it could be qualified, it could be adverse, it could be disclaimer. There could be different type of audit opinion. So basically, what is the audit risk? The audit risk is you were supposed to issue unmodified, but instead you issued qualified. You are to issue adverse, but you issued qualified. You are to give a disclaimer, but you give an adverse opinion. So basically, you give a wrong opinion. That's what is going to be considered as an audit risk. I repeat, you give a wrong opinion. That is what the audit risk is actually going to be considered as. Now, so why exactly is the auditor going to give an audit opinion? So basically, what happens is that there could be multiple things. So basically, the audit risk is made up of three things. What are these three things that the audit risk is made up of? One of them is called inherent risk. The other one of them is called the control risk. And the third one of them is called detection risk. And the third one of them is called the detection risk. Now, what exactly is the inherent risk? What exactly is the control risk? What exactly is the detection risk? So basically what happens is that the inherent risk is basically the risk of misstatement because of the nature of transaction, because of the complexity in the accounting standards. So at times you have got the nature of the transaction. At times you have got the complexity in the accounting standard. At times what happens is that there could actually be the use of estimates, etc., etc. They could all have an impact on the financial statement. So the risk that those things could ultimately have a misstatement arising in the financial statement is going to be considered as inherent risk. And what exactly do you mean by the control risk? So when I talk about the control risk is misstatement, the risk of misstatement due to weak internal controls, due to weak internal controls within the organization. So at times an organization could have weak controls, and those weak controls could actually lead to, I repeat, those weak controls could actually lead to the control risk. And the third one of them is called the detection risk. What's a detection risk? It's a risk that auditor fails to detect misstatement. So what exactly is the detection risk? The detection risk is the risk that the auditor fails to detect misstatement. Now, let me just guide you something. So when we talk about this inherent risk and control risk, this inherent risk and the control risk are also termed as risk of material misstatement. So I repeat, the inherent risk and the control risk are also termed as risk of material misstatement. Now let me just guide you people a bit. Basically what happens is that The risk of material misstatement is the risk that the financial may be materially misstated. Now when we talk about material, when we talk about misstatement, so what exactly is going to be the material? What exactly is going to be the misstatement? So when we talk about the materiality could be based on quantitative thresholds, or the materiality could be judged qualitative. Now, what exactly do you mean by the materiality on the basis of quantitative threshold? And what exactly do you mean by materiality on the basis of qualitative threshold? So let's just try to understand. So the quantitative threshold materiality is that if it is 1% of sales, that is called material. If it is 2% of assets, that's called material. If it's 5% of PBT, it's called material. So when you have got the materiality could be 1% of sales, could be 2% of assets, could be 5% of the PBT. That is how the materiality could be. And when we talk about the qualitative materiality, the qualitative materiality could be because of the nature of the type of transaction. Like for example, you have got the related party transactions. So when you have got the related party transactions, those related party transactions are qualitatively material. I repeat, those related party transactions are qualitatively material. Now, from the perspective of the exam, what happens is that I've talked about the material. Now I would talk about the misstatement. That what exactly do you mean by the misstatement? So when I talk about the concept of misstatement, let me just guide you. The misstatement could be identified using two methods. The misstatement could be identified using two methods. Now, what could be the two methods that could be used for the identification of misstatements? The two methods that could be used for identification of misstatement is that one of them is invalidity of assertion, and the other one of them is non-compliance with accounting framework. The other one of them is going to be the non-compliance with the accounting framework. What is it going to be? Non-compliance with the accounting framework. Now, so basically the misstatement could be the invalidity of assertion, or it could be non-compliance of accounting framework. Now, what exactly is this assertion going to be? So I usually remember the assertions using the mnemonic of C square compare. I usually remember it using the mnemonic of C square compare. Now, what exactly is this C square compare going to be? The C square compare is going to be what? It's going to be cutoff, completeness, classification, occurrence, measurement, presentation, accuracy, rights and obligation, and the existence. So what could actually happen is that you could have C square compare. I repeat, you could have C square compare. When we talk about the C square compare, the C square compare is actually going to be what? C square compare is going to be your cutoff, your completeness, your classification, your occurrence, your measurement, presentation, accuracy, rights and obligation, and the existence. Now, what exactly do you mean by all of this? So let me just give you a bit of a guidance about it. So basically what happens is that when we talk about the C square compare, it's basically, as an auditor, what you say is that you say cutoff, if the company has complied with the cutoff or not. Cutoff means correct period. The second thing that the auditor looks is that 100% of the transaction are being shown. The appropriate classification is also known as the allocation, that is allocating something into the PPE, into the investment property, into biological asset, things like that. Then what happens is that uh, there is this occurrence. Occurrence is that transaction has taken place. Transaction has taken place. So what happens is that the occurrence is going to be the transaction taking place, right? Then there is this measurement that is in accordance with the applicable IFRS and so on, so on, so. Now, then there is this presentation, which is presenting into the non-current asset, into the current asset, so and so. Accuracy, which is 1 plus 1 is equivalent to 2. With the assets, you have only shown the assets which you have right upon. The obligations, you have only shown those which you are actually obliged to, and the existence, which is the asset do exist. So one of them is basically you got to make sure that when we talk about the concept of assertions, the concept of assertions is that the auditor says, I repeat, when it comes to the concept of assertion, the concept of assertion is that the auditor says that the management has complied with all these assertions. If not, then that's a misstatement. And misstatement means that there is a problem. Now, similarly, what happens is that with respect to the accounting framework, so generally when you would look at any accounting standard, there is going to be the definitions, there's going to be the scope, which means applicability, there is going to be the recognition criteria, there's going to be the measurement criteria, there's going to be this subsequent measurement. Then what happens is that derecognition and then disclosure. So basically what happens is that, let me just guide you about it. Basically, you need to understand this specific concept. What is that specific concept? That in case if an entity has a non-compliance, we see what happens is misstatement. What is this misstatement? Misstatement is either there is a non-validity of assertion. If any of the assertion is invalid, there is actually a misstatement. Or the non-compliance of accounting framework, or the non-compliance of accounting framework. So from the perspective of the examination, you regularly come across, I repeat, from the perspective of the examination, you regularly come across this scenario, which is to evaluate the audit risk. Now, if the examiner says evaluate the audit risk, how exactly are you going to evaluate the audit risk? So let me just give you a bit of a guidance about this evaluation of the audit risk. When I say evaluation of the audit risk, the evaluation of the audit risk would actually mean what? This means he's saying identify the audit risk and then explain the audit risk. So how exactly are you going to identify and explain? So just try to understand. Basically, the approach that you can adopt is that if there is an item which is about which the amount is given, if the amount is provided, so what you should do is that you should calculate the materiality and comment if it is material. Then discuss the appropriate treatment and say there is a risk that the accounting would not be done in the manner which is discussed. Like for example, let me just guide you. I'll give you one of the idea that how would I actually talk about the audit risk. I would say that the receivables not confirmed are 7% of total assets and are material to the financial statements. In case if the recoverability of the receivables is in doubt, in case if the recoverability of the receivable is in doubt, the entity should, I wait, what does I say? Receivables are not confirmed are 7% of total assets and are material to the financial statements. In case if the recoverability of the receivable is in doubt, the entity should recognize a bad debt for the receivable balance and write down the balance in the SOFP. There is a risk that the entity does not write down the receivable balance, resulting in overstatement of receivable in financial statements. You get it? I bet the receivables are not confirmed, right? I bet the receivables are not confirmed. And those receivables which are not confirmed, because we would have sent external confirmation, they are 7% of total assets. And basically the problem is that in case if they are not recoverable, they should be written off. There's a risk that the entity has not written off these recoverable receivables, resulting in overstatement of the receivable balance. Now, let me just guide you about another type of the audit risk that could exist. You could say that the non-current assets, machinery is a total of 4% of total assets and is material. The damage to machinery is an indication of impairment, and machinery should be tested for impairment. There is a risk that entity does not test machine for impairment, resulting in potential overstatement of the machine balance in the financial statements. You get it now? Basically, there is a different way of writing down the risk. So all that you have to do is that if you have been given the amounts, talk about materiality, and then say if it is material or not, and then you talk about the issues, you talk about the problem, that what is the appropriate accounting and what is the risk that they might not do this accounting or that accounting. Now, so basically, one of the situations that I've discussed is about the audit risk also. Now let's move a bit forward and let's talk a bit further. There's another type of questions that are examined and that usually test the audit procedures. A lot of students, what they do is that they try to rote learn the audit procedures. I repeat, a lot of students, what they do is that they try to rote learn the audit procedures. Remember one thing, you don't have to rote learn the audit procedure. I repeat, remember one thing, you don't have to rote learn the audit procedure. There's actually a method by which you could actually prepare the audit procedure, and that's a very simple method. Now, what exactly is the method that you can adopt? So let me just guide you. Basically, what exactly is the procedure? So as an auditor, you define the audit risk first. So when you define the audit risk, so always adopt from the perspective of the exam. You adopt an approach, which is you need to think what could go wrong with a financial statement. I repeat, as an auditor, when you write down the audit procedure, so what is the audit risk? The audit risk is that you have to think that what could go wrong with the financial statement. And what exactly are the audit procedures? Audit procedures are simply the actions performed by auditor to test So I repeat, what happens is that when we talk about the audit risk is the risk is about you need to think what could go wrong with a financial statement. But when it comes to the audit procedures are the actions that the auditor performs in order to check if something has gone wrong or not. Like for example, I'll just guide you something. Whenever you produce an audit procedure, there are few things that you got to keep in mind, which is three things. Number one of them is action. Number two is basically source document. And number three is the objective. I repeat, as an organization, what is it that you need to do? Action, source document, and the objective. Now, what exactly is the action going to be? What exactly is the source document going to be? What exactly is the objective going to be? So the actions with respect to the audit procedure could be these. Could be A, E, I square, OU. Now, what are these A, E, I square, OU? That's basically analytical procedures. It's the external confirmation. Then there is this inquiry, inspection, observation, recalculation, right? So we have got these different actions, which is A, E, I square, OU. It's about analytical procedures. It's about the external confirmation. It's about inquiry, inspection, observation, recalculation, all of them. Now let's just have a bit of a discussion about it. So basically what happens is that as an auditor, like whatever the audit risk is, you can take an action. Like maybe for example, your action could be inspect BOD meeting minutes. Your action could be obtain external confirmation from customers. So there could be multiple type of actions. So just remember action, source document, and objective. So I'll give you some guidance as to how does it operate. I'll give you some guidance as to how does it operate. For example, you might say that inspect the purchase invoice to confirm that the cost is correctly recorded. Inspect the BOD meeting minutes to confirm that. What is it? You got to inspect the BOD meeting minutes to confirm that. Inspect BOD meeting minutes to confirm that. To confirm that management is committed to find a buyer for the property so that the conditions for classification as held for sale are met. Now always remember something. If you want to do good audit procedures, if you want to write good audit procedures, there's something you have to work upon. I bet if you want to write good audit procedure, there is something that you have to work upon. What is it that you have to work upon? You have to make sure, I bet, when it comes to the audit procedure, you got to make sure that there is something that you have to work upon. What is it that you have to work upon? You have to work upon the accounting standard knowledge. I bet you got to work upon the accounting standards knowledge. And what I'm actually going to do is that I'm going to give you a link. You could search the channel. Okay, let me write it in a proper manner. You could search the channel Scriber Academy, and you could search the channel Luqman Rafiq. You could search both the channels on the YouTube, and what you would do is that you go to the playlist over there. So under the playlist, you will be able to find the IFRS summaries. Under the playlist, you will be able to find the IFRS summaries. So you could refer to my, I bet you could refer to my these channels, the channel of Scriber Academy. You could refer to the channel of this Luqman Rafiq, and you could have an idea that there is this IFRS summaries available. So once you have a good grip over the IFRS summaries, you can do the accounting standard well. Now, so basically that's what about the audit procedure is. So I told you people earlier also that when it comes to this AAA paper, you should actually know that there are areas, and I'm actually revising each one of them. So it's actually the audit risk, the business risk, that is done. The audit procedure is also done. Now what I'm going to do is that I'm going to go through the audit report areas. Okay, let me just give you a bit of a guidance about this audit report. So what actually happens with respect to the audit report, there are few important aspects that you need to understand, which is like under the audit report, there are some key things that you need to know, which is the different type of opinions that could actually be provided. So there are important section of the audit report. I'll just explain them. First of all, you have an unmodified opinion. What is this unmodified opinion? The unmodified opinion is that when you say the financial statements give a true and fair view, that's actually called unmodified opinion. Then you have got a qualified opinion. What exactly do you mean by qualified opinion? So the concept of qualified opinion is that you say except for the matters discussed in the basis for qualified opinion section of the report, the financial statements give a true and fair view. So basically what happens is that you've got unmodified opinion, you've got qualified opinion. The qualified opinion is gonna be what? The qualified opinion is gonna be except for the matters discussed in the basis for the qualified opinion section, the financial statement give a true and fair. Then you have got adverse opinion, and the adverse opinion is given when adverse opinion actually means that we say financial statement do not give a true and fair. Adverse opinion is that when you say financial statements do not give a true and fair. And lastly, you have got disclaimer of opinion. Now, when I talk about the disclaimer of opinion, the concept of disclaimer of opinion is that you say we do not express an opinion on financial statement. We do not express an opinion on financial statement. So when as an auditor, you don't express an opinion on financial statement, it's actually called disclaimer of opinion. Now, when do we give a disclaimer? When do we give so and so? So let's just try to understand this thing. Basically, from the perspective of the audit, you have to classify the matters to be material, non-pervasive. Then you have to say material, pervasive. Okay. Now see what actually happens is that when we talk about the audit opinion, your audit opinion is going to be dependent upon whether the matter under consideration is pervasive or non-pervasive. The second thing that is going to depend upon is that if there is a material misstatement or if there is an inability to obtain sufficient and appropriate audit evidence. Now let me just give you a bit of a guidance. So for example, if the matter is material non-pervasive, and if there is a material misstatement, you give a qualified opinion. For example, if the matter is material non-pervasive, inability to obtain sufficient appropriate audit evidence, again you give a qualified opinion. And when it comes to the matter to be material pervasive, and if there is a material misstatement, you give an adverse opinion. And here you go, you give disclaimer of opinion. So your audit opinion depends upon whether the matter under consideration is pervasive or the matter under consideration is non-pervasive. I repeat, your audit opinion is going to depend upon whether the matter under consideration is pervasive or the matter under consideration is non-pervasive. So like you can have what? You can have qualified, you can have adverse. You can have qualified, you can have disclaimer, depending upon what exactly is the issue. Now, when we talk about the matter to be pervasive, so pervasiveness actually means that it is either multiple elements of financial statement are misstated, that's number one, or single item but significant misstatement, and the third one of them is pertains to the key disclosure. Like for example, let me just guide you. How do you get multiple elements of financial statement are misstated? What exactly do you mean by this? When we say multiple elements of financial statement are misstated, what exactly do you mean by this? For example, in your financial statement receivable, in your financial statement payable, in your financial statement sales, they are all misstated. So I repeat, there are multiple elements misstated, receivable misstated, sales misstated, payable misstated, multiple elements are misstated. So what actually happens is that if the multiple elements are misstated, so ultimately what is going to happen? This is actually going to have a pervasive impact. I bet this is actually going to have a pervasive impact. Now what next is there? There's a single item but has a significant misstatement. So like for example, if there is a misstatement which is 25% of the net assets, if there's a misstatement, no, you won't have two opinions. Like if you are not sure, you could just talk diplomatically that if it is pervasive in nature, then adverse. If it is not pervasive, then qualified. That's how you can go about. Now, 25% of net assets, or let's say some 50% of the PBT, etc. So if you have got items like this, they're all gonna be having a pervasive impact. Or lastly, if it pertains to a key disclosure. Now, what exactly do you mean by key disclosures? So when it pertains to the key disclosure, it actually means that, like, for example, if there is a going concern disclosure, etc., etc., so that could actually have a pervasive impact. So this is something that's important that you need to understand. Now, there is this one more element which is called the concept of key audit matter, which we also call the CAM. Now, what next is there? So when we talk about the concept of key audit matters, you need to understand that what are the key audit matters? The key audit matters actually mean that significant risk matter from the perspective of the auditor. The matters which are of significant risk from the perspective of the auditor, they are going to be considered as key audit matter. Now, what happens is that when you go about doing the audit, there are high risk matters. Like you identify some matters to be high risk matters. So those high risk matters are considered to be the key audit matter. As per the definition given by ISA 701, a key audit matter is matter which is discussed with a matter which is discussed with management and a matter which is discussed with the management and those charges governance and is a significant matter in the auditor's judgment. So basically, I've told you from the perspective of the audit, a high risk matter is going to be considered as key audit matter. A high risk matter is going to be considered as key audit matter. And these key audit matters, they are shown under three places. I repeat, the key audit matters are shown under three areas. Now, what are the three areas? Is the voice clear now? Okay, is my voice clear? Or is there an issue with my voice?
It's clear.
Okay, thank you. Now, when it comes to the audit, there are basically three aspects where it actually goes about. Either the key audit matter is going to be shown under the CAM section, or the key audit matter is going to be shown under the basis for modification section, or it is going to be shown under material uncertainty to going concern section. I repeat, from the perspective of the exam, the key audit matter is going to be shown under these three sections. Now, where could it actually be shown? Where could it actually be shown? It could actually be shown under the CAM section. It could be shown under basis for modification. It could be shown under material uncertainty. So now, when do you show it under CAM section? When financial statements are not misstated. And what do you show under the CAM section? You show three things. You basically talk about matter. You talk about the relevant note in the financial statement. And you talk about the audit procedure which you have undertaken as an auditor. So I repeat, what do you do with the CAM section? With the CAM section, you do three things. I repeat, what are the three things that you do? You do three things, which actually include what? You do three things, which actually include what? That includes that you actually talk about the matter. You say that why is it a matter? What is the matter? You refer to the relevant notes from the financial statement. And also what you do is that you talk about the audit procedures that you have actually performed with respect to this specific audit. And when do you show in the basis for modification para? When the financial statements are modified due to this matter. And when do you show under material uncertainty section? When material uncertainty to going concern exists. When material uncertainty to going concern exists. So I repeat, the key audit matters are actually shown in three places in the financial statement. What are the three areas where the key audit matters are shown? The key audit matters are actually shown in three areas. One of them is CAM section, one of them is a basis for modification section, and the third one of them is material uncertainty to the going concern section. Now, the last one area, which is basically the difference, what exactly is the emphasis of matter. para. Then there is this other matter paragraph also. Now, what exactly do you mean by emphasis of matter? What exactly do you mean by other matter? Let's just try to understand this. When we talk about the emphasis of matter, when we talk about the other matter, let's try to understand. The concept of emphasis of matter is basically when auditor wishes to draw management's attention to a matter correctly presented in the financial statement. There is a matter which is correctly presented in the financial statement. So if the auditor wishes to draw, sorry, not the management, user's attention. So whenever the auditor wishes to draw user's attention to a matter which is correctly presented in the financial statement, so what does he do? He includes that in the EOM paragraph. So EOM para is when something is correctly presented in financial, but still the auditor wishes to draw management's attention to it. So he mentions that in the EOM paragraph. What exactly is going to be the other matter paragraph? The concept of other matter paragraph is that the concept of this other matter paragraph is that the auditor wishes to draw attention of users to matters not related to financial statement. Like for example, let me just guide you. For example, the matters which are not related to financial statement, what are the examples for that? The matters which are not related to financial statement, the examples for that are what? Um, the examples for that could be that this is the first year of audit. The matters could be last year financial statements were audited by another auditor, so that could actually be that. So I mean, when we talk about the other matter, that could actually be that. So I've actually told you that how the audit report is actually going to go about. I've actually explained to people that how the audit report would have an impact on this financial statement, how the audit report on the financial statement is going to be discussed. Now, there is one more aspect with respect to the audit report, and that's actually the impact of ISA 570, the going concern, and the audit report. So when I talk about the ISA 570 going concern and the audit report, so you know this thing, that what exactly is the concept of going concern. So the concept of going concern is that it's basically that the entity will continue for the foreseeable future. Now there could be multiple things that could happen. One of them is basically a situation that entity is not a going concern. I repeat, one of the situations could be that the entity is not a going concern. And the financial statements are prepared on breakup basis. Now, what exactly do you mean by this financial statement are prepared on breakup basis and etc.? Let's just try to understand. First of all, it could be yes, it could be no. So number one that I said is that entity is not a going concern. So the financial statements are prepared on a breakup basis. Yes. So what happens is that you give unmodified opinion with an UM paragraph. You give an unmodified opinion with an EOM paragraph. Secondly, the financial statements are not prepared on a going concern on a breakup basis. You see, if the company is not a going concern, you should prepare financial statement on a breakup basis. If you have not prepared, then it has to be an adverse opinion. If you have not prepared, it has to be an adverse opinion. What? It has to be an adverse opinion. Now what next is there? So basically, from the perspective of the going concern, one of them is entity is not a going concern. The second thing is that material uncertainty related to going concern exists. And what actually happens is that the disclosures provided by the entity are adequate. The disclosures provided by the entity are inadequate. Like what happens is that there could actually be material uncertainty to going concern. What do you mean by material uncertainty to going concern? The material uncertainty to going concern would actually mean what? Material uncertainty to going concern would mean that uh, like maybe something could happen, maybe some court case decision is going to be announced or anything, and that would ultimately have an impact on the going concern end. So if you have provided adequate disclosure, then what happens is that there is a material uncertainty to going concern section in audit report that's provided. Similarly, if there is an inadequate disclosure, you could give either qualified or adverse. Similarly, non-disclosures, again you could give qualified or you could give adverse. You get it now? So basically that's about the audit report. Now I'm gonna stop here, and I would actually invite you people to ask anything that you would like to ask with respect to this AAA.
I have a question.
Yeah, sure.
Yeah, how does the examiner award the professional marks?
Okay, good enough. You see, the professional marks are actually being awarded in 4 aspects. Now, what actually happens is that when the professional marks are being awarded in 4 aspects, so the question number 1 that is going to be there. So you would have these 3 professional skills that are going to be tested. And with respect to question 2 and 3, there's going to be 2 professional skills tested in each of the question. That is how it is going to be. In fact, question number 1, 4 skills, and then two skills. Now, how exactly are those skills going to be answered? See, amongst the 4 professional skills that are actually there, one of them is basically evaluation and analytics. One of them is professional skepticism. One of them is communication. Now, first of all, if you have to get the professional marks, so in order to get the professional marks, you should make sure that you have the technical knowledge. If you don't have the technical knowledge, you cannot get the professional marks. So first of all, you should have the technical knowledge with you. If the technical knowledge is there, you can get the marks. Now, when it comes to, when it comes to, let's say the communication, so you'll get the communication marks on a lot of things like the format of report. You will get the communication marks on the basis of, you will get the communication marks on the basis of basically the structure, the language used, the presentation, etc. Then there is this professional skepticism skill. How do you get the marks for the professional skepticism? So when we talk about the professional skepticism, try to understand something. With respect to the professional skepticism, what is actually going to happen is that it's like when at times the scenario is given. When it comes to the scenarios that are given, at times in the scenario, there are those situations where you have to have a questioning attitude. Like some information is given, you have to doubt that information. You have to create doubt to that information. You have to question those information. You have to create questions that if that information is actually relevant or not. So basically, what are you gonna do? You are gonna say that this skepticism attitude is something that is going to lend you marks. So you have to raise those points. Now, third one of them is basically your commercial acumen. Like at times in a lot of situations, you might actually answer that we are being given the audit and we are also being given the other services. And you say that uh, refuse the other services. Although the other services may be more profitable venture, the other services may be more revenue generating venture. So your commercial acumen would make you say that stick to the other services, drop the audit. If you cannot manage the ethical issues, then drop the audit, manage, obtain the other services. And lastly, what you actually have is that evaluation skills. So in case if the scenario comes where you have to actually calculate the different type of ratios, where you have to evaluate the information, where you have to analyze the information, etc. So in that case, what are you gonna do? You're gonna use that, you're gonna mention those things and you'll get the marks. So one thing that I would suggest to you people is that don't actually think, don't actually think that this is a rocket science. Don't actually think that this is actually a rocket science. This is not a rocket science. This is not a rocket science. This is something very simple. You do the normal questions the way you do the normal question, and you will get marks. You get it? Okay. Any other questions? Anyone?
Hello, sir.
Yeah, hello.
Yes, I would like to throw light on the publications that was given in the about the social and environmental reporting, and then the ISQM, sir.
Sorry, which one?
International Standard on Quality Management.
Okay.
And then there's a question, I think the part C in the mock exam in the platform, wherein the examiner is asking a question for risk, for which to identify the risk in the planning and review stage concerning climate changes, sir.
Okay, I can keep another session for that where I could actually solve the whole mock on this specific platform.
Okay, sir.
Okay, there is multiple requirements. One of them is one of the student is asking that what is material uncertainty to going concern. For example, there is a court case that is there. Now, with respect to that court case, what is actually happening is that there is actually a court case against your company. In case if you lose that court case, in case if you lose that court case, your company is gonna get bankrupt. So what actually happens is that in case if your company is gonna get bankrupt, so resultingly, what do you need to do? You need to make sure that you disclose it in the notes to the financial statement properly. So if you disclose this in the notes to the financial statement properly, this is actually going to be reflecting the material uncertainty to going concern. Now, if the company does not, I repeat, if the company does not give this appropriate disclosure, so this means that the company audit report should actually be qualified. But if the company has given appropriate disclosure, then the auditor should give material uncertainty to going concern paragraph. Okay, there's another requirement that I have, and that's also the other information. Okay, now you see what happens is that the other information actually means that you need to prepare the financial statements. Generally, what we have got is that there is an annual report that is published, and that annual report has got a lot of things other than financial statement. Like it has got a KPI report, it has got the CSR report, it has got the other communication like director message, etc., etc. So other information means other information accompanying the financial statement. So what happens is that it is the responsibility of the auditor. I repeat, it is the responsibility of the auditor to read other information accompanying the finances. I repeat, it's the responsibility of the auditor to read the other information accompanying the financial statement. And if any inconsistency found, in case if any inconsistency found, what do you need to do? You need to make sure, I repeat, if any inconsistency down, you need to make sure that you mention in other information section of the report. Okay, there is another requirement where to use other matter. Other matter is when you are referring to a matter not pertaining to the financial statement, you give other matter. But when it comes to the emphasis of matter, the emphasis of matter is basically what? The emphasis of matter is that the emphasis of matter paragraph is given when you refer to a matter which is correctly reflected in the financial statement. Now, what else is there? Okay, any other inquiry that you people have? Okay, when you criticize the audit report, so you have to actually see that what should be the content, what should be the layout, what should be the opinion. Like for example, like the headings of the different sections of the report, the type of opinion that is given in the given circumstances, the language that is used, the information that is provided. So when you have to criticize the audit report, you have to make sure that you actually focus upon. I repeat, when you actually do this, you have to make sure that what do? You actually uh, talk about. You talk about what? You talk about the content of the report. You talk about this specific layout. You talk about the opinions. All of this you have to talk about. Now, what I'm actually going to guide you people now is that there's basically a playlist which we are also going to make available to you people. So I'm actually going to guide you about this playlist. It's youtube.com. Just wait. Okay, I know my internet is a bit weak right now. Okay, you could just go on to search Scriber Academy. And when you would go on to search Scribble Academy, you would go for the playlist. In the playlist, you could search, you could sort by latest video added, and you could try to find out the AAA Advanced Audit and Assurance P7. You go to this full playlist, and in this full playlist there are many things, the many exam questions, etc., that I've done. So what you could do is that you could just go on and you could just try to, I bet, you could just go on and you could just try to identify that what exactly are the different type of questions that are available. So you could just go on for these different type of questions available. Right? Okay. So thank you very much, guys, for your time. Thank you for attending the session. Hope you enjoyed the session. So see you inshallah again. And I would just keep one more session in which I would try to go through the mock examination available on the ACCA website. So thank you very much, all of you, for time. Thank you for attending the session. See you again, inshallah.